This is your daily real estate syndication show, and I'm your host, Whitney Sewell. Today is a highlight show that's packed with value from different guests around a specific topic. Don't forget to like and subscribe, but also go to lifebridgecapital.com where you can sign up to start investing in real estate today. I hope you enjoy the show. Our guest is Leybovich and Sam Grooms. Thanks for being on the show, guys.
Thanks for having us, Whitney.
Thanks for having us.
Yeah.
Fun.
Yeah, I'm excited to have you all. And I know you all are the guys making it happen. Isn't that right, Ben?
Oh, we do a few things here and there.
Yeah.
We're quite bashful, you know.
I don't think bashful is a way to describe Ben.
So these guys have been investing in multifamily for a long time. They're great syndicators. They're making it happen. I'm looking forward to getting into this conversation. But Ben and Sam, let's get started a little bit give us a little update on what you're working on right now, and maybe briefly tell us, what you've done up to this point in the syndication business, and then let's dive right in.
The last podcast Sam and I recorded, I was playing back the podcast with my wife. I happened to be in the car. She just looked at me and said, "You sound like such an ass." So today, because this is a family show and because you got a reputation to protect, I'm just going to behave myself. And the first way in which I'm going to do that is I will allow Sam to go first.
Well, thank you, Ben. So in the last 6 months, we bought 215 units split between two properties, $11 million purchase price. We raised about $8 million for those two deals.
Purchase price is about $20 million. Purchase price is $20 million.
19.
11 million. One of them was 11 million. Right? So we raised what? 4.5 for one, 3.5 for the other one. Good deals.
Nice. So tell us, what is your model right now, your structure of your partnership between, Ben and Sam, and what are your roles?
We
both underwrite. We get a deal from brokers. We both handle most of the underwriting. We sit down, go visit the property together. And then at that point is where we kind of diverge in our roles. And it's kind of happened gradually between the first and the second deal that we just mentioned. I'll handle mostly the debt, and Ben will handle the equity. And then we both manage the property pretty equally, meet with all the contractor appointments and dealing with the renovation.
Reporting and things like that. And I've been buying multifamily since 2006. It's just, this partnership is fairly new, about a year old. I've been doing this for a long time.
Yeah. So how did the partnership change from when you first started to now?
I don't think it has. We like each other. We trust each other. And our areas of expertise are very complementary in the way we look at things, and with the way we process things is very complementary. So it's just fell in really, really good, and there hasn't been a need to change.
Well, what has changed is at the beginning, we were both trying to do everything. And like I just mentioned, we kind of naturally took on the areas we were strongest at and kind of did our own segregation of duties just organically over the last 6 months.
So now you're just doing everything, Sam?
Pretty much. That's a nice way of saying I do everything.
Hey, somebody needs to look pretty while he does all of that stuff, okay?
So again, I do everything.
So how did you all determine who would be paid what in the beginning of your partnership? I've heard people ask that. Well, we're looking at partnering, and how do we structure that, and what should that look like, and how do we do that?
I'll give you a very simple answer. If people are concerned out of the gate about who's going to get paid for what, they're not looking at the right fucking thing. What they should be
Family
doing,
show, Ben.
figuring out how to underwrite deals, how to get taken seriously by brokers, how to get some deal flow, how to raise some money. Sam and I never even had a conversation about who gets paid for what and why. It makes sense. Once things make sense, they make sense. They don't require a conversation. So I don't know, Sam, if you disagree with me or what, but we just never, ever talk. Look, I want a great deal. He wants a great deal. That's where our focus is to find a great deal. Everything else is going to fall in place if we have a great deal. All of this other nonsense is just nonsense. It's just you're going to focus on how much you get paid. How does that help you get a deal?
To be more specific, we split everything 50-50, but yeah, like Ben said, there wasn't really much discussion early on about how we were going to structure it. It was just, we just started looking for the deal before we worried about anything else. Because if you don't have a deal, what does it matter?
There was a discussion about, is this guy an ass? Do I even want to go there?
No, I appreciate that, and I appreciate both answers. But I know that I just get that question often. I've heard it myself, and so since you all are in this partnership,
that's a silly question. Listen, the reason most people don't make the money we make and don't buy the apartments we buy is because that's the kind of thing they focus on.
Yeah,
that's exactly the wrong thing to be focused on if you really want to be a player. This is what we're trying to tell you is like, yes, you're hearing this question a lot. And guess what? Only a few of the people you talk to are actually doing deals. How do those two things line up, right? The people doing deals aren't worried about stuff like that.
Yeah, and I agree. And if you both have that relationship that you're going to partner, then it's not a big concern anyway. It's going to work out. You can focus more on the finding the deal and the underwriting like you're talking about.
Right.
So, tell us a little bit about a recent deal that you all have closed on. Maybe the most recent one. Tell us, why you bought the property, what looked good about it, and maybe your buying criteria. Did it meet your criteria or not?
Ben, should we actually talk about Silvertree so we can talk about some results as well?
Sure.
So Silvertree we bought about 6 months ago. It was 98, or it is at 98 units. We purchased it for $8.2 million, raised about 3.6 of equity. The rents, I think, were $600 when we took over, Ben, on blended.
Not quite.
Yeah, a little under 600. We're spending about $12,000 per unit to fix up the property. 7,300 of that is on interiors, but that's giving us a $340 rent bump per unit. So we're getting rents up to over 900. And that's kind of what you have to see in the Phoenix area is about a $300 increase.
So mathematically, let's back it up and explain to folks why you have to see what you have to see. So Whitney, most of your value add is a function of filling up vacancy, right? In most municipalities, you go to Houston, you go to Ohio, Columbus, Cincinnati, you find a quote unquote mismanaged property, right? That's what we all want. We want that mismanaged property. Well, what does it mean mismanaged? Mismanaged means you've got some vacancy because the ownership doesn't want to deploy capital to bring units up to par. A lot. They're running at, 78% occupancy, 73% occupancy, 84%, whatever. And so when you take that over, majority of your value add is a function of going in, fixing what needs to be fixed, and filling up the vacancy, bringing it to 94%, 95%, whatever the market going physical vacancy is, right? That's the majority of your value add in most value add plays. And then you put some lipstick on the pig and raise the rents $50, $60, and you call it a day, okay? The problem in Phoenix that grows 1.5% in 1 year is that there's such a population explosion here and such a lack of inventory in $800 to $1,200 apartments that there's no vacancy. Even the most horribly run property is generally speaking operating at market occupancy. So what does that mean? What does it mean to buy value add in a place like Phoenix that's an extremely high growth market in a county that is the number one growth county in America? What does that really mean? What does it look like? Well, what it looks like is you have to actually do the value add. You have to actually create the additional revenue. There is no vacancy. When we took over Silvertree, there were 2 vacant units out of 98. When we took over South Mountain, there was 1 vacant unit out of 117. There's no vacancies because there's just no vacancies because there's a lot of demand because of the population growth, right?
But we can't underwrite no vacancy.
But you can't underwrite no vacancy, right? So you need value add. You need value add just to get like the South Mountain, which just closed 3 weeks ago. I think the sub-market is annualizing at like 2.6% vacancy. The entire sub-market. Okay. What do you do with that? You underwrite 5 or 6% vacancy because that's what is sustainable historically. But then you need value add to compensate for the difference between the 6% and the 2.4% in the marketplace right now, which is not sustainable. You have to assume it's not sustainable, right? So you need value add just to compensate for that and break even. And then you need a bunch more value add in order to actually make returns. So what it looks like is $300 per door plus. And that's the only thing that works in Phoenix because there's no vacancy.
And I heard your reaction when I said 12,000 per unit. So we're spending 7,500 on the interior, and we're basically touching everything in the interior of the units. Completely new kitchen, from cabinets, granite countertops, stainless steel appliances, plumbing fixtures, lighting fixtures, new flooring, paint, just basically touching the entire, as well as bathrooms.
Yeah, that's awesome. You can get the $300 rent bump. I mean, and is that, by the time, well, I guess give me your timeline on far as how many units is it and getting it all renovated?
Well, let's talk about the Canyon.
So what we do is we're on lease renewals, we are bumping rents quite significantly. So say $200, $250 rent bump. That naturally gives you people who are going to move out and not renew them. And so we did that just enough. We figured out how much we would get so we can get 5 to 6 units available per month that won't renew. And then we go in and fix those up. So, and that really helped us in December and January, where I think we had, 39 lease renewals between those 2 months. So 39 out of 98 units in 2 months. So heavily weighted in on those 2 months. And we obviously couldn't renovate all of those units. So we went in, just increased rents, $250. And a lot of people were willing to accept that. But we had 5 or 6 people said, we're not going to accept that. And that was perfect. We got our hands on those units. We were able to renovate. And then we still got a ton of loss to lease that we captured on the classic renewals.
Hey guys, it's Whitney. I wanted to take some time to introduce you to my good friends over at PassiveInvesting.com. They're a national private equity real estate firm based out of the Carolinas. They focus on acquiring institutional quality apartments and self-storage facilities. They do this with private accredited investor funds. They have a portfolio of over $700 million in assets and control over $250 million in equity from their investors. PassiveInvesting.com makes it easy for you to start investing in real estate without all the hassles. They even have an average 62% repeat investor rate in each offering they put together. They even have a real estate debt fund that offers hard money loans to local fix and flippers across the U.S., which currently has a 0% default rate. To help you learn more, they've put together a free passive investor guide that outlines the 7 red flags for passive apartment and self-storage investing. Visit PassiveInvesting.com/red flags to download the PDF now. That's PassiveInvesting.com/red flags. Our guest is Jeff Greenberg. Thanks for being on the show, Jeff.
Well, thank you, Whitney. I'm happy to be here.
Can you speak to how important it is to build relationships when you're getting started? And us talk about that a little bit and just how you did that, maybe how that's changed from how you were, building relationships and nurturing the relationships from the beginning to the way you are now.
Yeah, it is extremely important to build up relationships, to find other people that you can help or they can help you, or they know somebody that they can refer you to. It's just the whole business of real estate is helping each other and being of some kind of service to each other. In the beginning, it was difficult. As I said, I was very quiet. I was very introverted. And as I opened myself up more and more, now I could go into these situations and talk to people and walk up to people and say, hey, what are you doing? What kind of business you in, or what kind of, if it's a real estate meetup, what are you doing in real estate, or what have you done? You never know who's going to be able to refer you to someone or something, or maybe they're going to invest with you, or maybe they know somebody that's selling a property that you may be interested in. It's definitely a relationship business. My first 2 deals that I got were from a broker that I had met through LoopNet, of all places, and he happened to have been, he was born in California, but he was living in Texas. And we got that relationships because we had the California connection. And every time I was in that part of Texas, I stayed with him and his family, and we became friends. And we still text back and forth some and communicate some, even though we don't have a property involved anymore. But, it is the relationships. It's the relationships about getting the deals, as well as the relationships with investors. On the current deal that we just closed on part of the raise, it was part of the funds were raised by people that I had met in different situations, and they were bringing in their network. So by me expanding to their network, I'm expanding my reach out. And that's extremely important when you're raising funds, when you're looking for deals, when you're formulating relationships.
It's a team sport, isn't it? A team sport.
And it's definitely a team sport. I remember reading a blog or something on Bigger Pockets where someone was talking about, well, I'm very introverted and I'm kind of afraid to talk to people, and I kind of went into it. I said, get over it. Do whatever you need to get past that. If you need to go to Toastmasters, if you need to push yourself in front of groups to talk to people, take a speech class at a college where you're forced to give presentations in front of people, whatever it means, whatever it is, get past it, because that's very difficult unless you just want to be an underwriter or something and you're just going to sit there and play with the spreadsheets and do some back office type of stuff. If you're going to be out there front facing, running your business, you better be able to talk to people, talk to vendors, talk to property managers, property inspectors, whatever. You need to be able to do that without being in fear of talking to people.
What's been the best place that you've found those just key relationships that's helped move your business to the next level and people you can help as well?
Well, a lot of it started out with the different meetups that I attend. The difficulty I found in the beginning it was great. I met a lot of people that were farther ahead than I was, and I still go to some different boot camps where I meet up with some people that are at my level or above my level. Probably the most influential one is a mastermind that we've been involved with, and there are some extremely impressive people in that mastermind that are totally open to talking to anybody at whatever level, and for the most part they've been there, done that. And to ask them, say, hey, what do you think of how I wrote my offering? Would you have changed anything? What about the structure of my deal? What do you think about that? Different things like that they could look things over and in a snap give you a comment on what their feelings are. But most of the time nowadays, it seems like on the local stuff, I may be the most experienced person in the room. So I, again, need to go places where I'm out of my comfort zone, where I'm standing up in front of people that are a lot more skill than I have, done a lot more than I am. And in our group, we talk about, what we can offer the group. And that was one of the more scary things is saying, wait a minute, how do I offer anything to this group? I mean, this is, a phenomenal group of people. And so to try to come up with what I could offer them is probably one of the more difficult things, is how I can help them in their business. As you keep pushing yourself, you keep finding things that will improve you.
Yeah, and like you said, as you get out of your comfort zone, it causes you to grow, and then you start to grow in other areas that you didn't even know were there. So initially, maybe you were going to those local meetups, and that caused you to grow. And then all of a sudden you realize that, okay, I got to find some other meetups or other groups like that mastermind, and that's caused you to grow even that much more and pushed you to another level.
Oh, absolutely. And you've got to be comfortable being uncomfortable.
We were talking about, just how you got started and how other people can get started, and just the importance of being driven, being ready to just dig in and make it happen. And then the importance of relationships. And, what would be the thing now that you're really focused on? You're building these relationships, you're keeping those relationships going, you're continuing to do that. I guess I wanted to ask you too, how do you manage to make time to continue nurturing all these important relationships?
With a lot of the different stuff that I'm doing, I have other people doing the things that don't need my attention. I have other people that are looking for the deals for the most part, underwriting the deals. I have a team that we've been going out and doing due diligence with, or that's something that we've actually been delegating out to property management companies where we've been contracting with them to do some of that. So that reduces the duties that I have. I have been working to get my team to do more of the fundraising. because that seems to be the one that a lot of people are more resistant to, that they find more difficult and are more uncomfortable with. So I try to offload as much as I can and, teach the rest of the team to do it. I think it was Chris Clothier that I heard talk at Joe Fairless's conference 2 years ago. I think it was his first one. And one of the things that Chris said was the CEO's responsibility is to train his employees to replace him. And I thought, yeah, that's right. I want to train them so they can do the jobs that I don't need to do. And that means I could be doing other things to develop the company and to, reach out farther. But it's training people, getting people that can replace the jobs that I'm doing. And so that's, one of the things that I try to do now. And right now it's mainly the fundraising aspect of it, but my team does most of the other stuff.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the #1 resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.